Welcome back. You're watching HFO-TV, co-sponsored by AMF Capital, the Ball-Janik Law Firm, the Butler Exchange Group, and the construction firm J.R. Johnson.
Welcome back to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate. And today we're going to be joining Tim Steele, director of AMF Capital, a very prominent lending resource here in in our world, multifamily and commercial. We've done a lot of transactions with him over the years, and kind of want to get an update of kind of what's going on. I mean, there's a lot going on. We know that in the world. It's April 1st, so we just finished first quarter of 2020, and just kind of see what's happening in the lending environment. There's a lot of unknowns. So again, Tim, thanks for taking the time out today. We're trying this new medium with these this social distancing. So again, we're not in person with each other. We are more than 6 feet apart. We're actually quite a few hundred miles apart, but thank you again, and let's just kind of jump in. It's end of first quarter, 2020. We're all in the middle of this pandemic. Let's maybe talk about what are you seeing with current transactions? We've closed just a couple deals last week. I mean, are you confident those are still going to go in the month of April, or what are you kind of seeing? And then we'll get in kind of long term.
Sure. And I do want to say, stay home. That's just my public service announcement. Anybody watching this time. I first would like to discuss, and I have a few notes here regarding kind of what we've all been used to, maybe starting off there, and then that's what will bring us in. Low rates, max LTVs, pro forma financing, interest only. I'm sure a lot of people that are your clients and viewing this just know what we've been doing for the last 5 years. Been super aggressive, super cheap loans, super fast in the sense of as fast as things can go. And cash out's not been a problem. Lenders were doing cash out. They weren't necessarily asking a lot of questions. What are you going to do with it? Some banks had their forms for OFAC and all the, Patriot Act stuff that you're not going to go do anything illegal with it, but it was pretty liberal. And that's all changed. And that's what we'll talk about today. As far as our deals, we did close a nice transaction about 3 weeks ago ahead of all this. And we did have a deal that's currently set to close in a couple weeks in Sherwood that thankfully we locked the rate before everything started changing. And we did get a retroactive change, which we'll talk about with what is kind of starting to happen with all lenders going forward, of which our client was palatable for them. Right. To stay the course.
I mean, it's the kind of the amazing thing on this whole deal is, we were talking about these great rates and, all these things just as little as, 30, 45, 60 days ago. And it just changed in an instant, which is, I think, is what's kind of made a lot of people unsettled as to, we don't know. And again, nobody knows how long this is going to be and what it's going to look like. So, maybe kind of shine some light of what lenders are saying or looking at, specifically in multifamily in this region, how you're approaching, new loan requests and things of that nature.
Well, the easy one is I'm not approaching a lot of new loan requests. I'm actually advising a lot of people if they have sellers that are open to allowing us a 45-day extension. I don't want clients to get wrapped up in today's new underwriting for it to just go all back to potentially somewhat of normalcy come summer or fall. Okay. And we'll talk a little bit about that too. We'll just use an example because the date's easy for me to remember real quick. It wasn't 60 days ago how fast this has all happened. My birthday's on March 20th. That happened to be on a Friday. And the reason why that was so memorable is because that Monday I had 6 refinances and 5 purchases I was looking at, all multifamily. And every single one by Wednesday either retracted their offers, increased the interest rates by over 1%. And as I presented it to clients, we didn't have any money up, and nobody's financially harmed. So every single one of them got put on hold, if not delayed or canceled. So it happened really fast. And the day of this recording is April 1st. So right. It hasn't even been 30 days.
Yeah, I guess, it's been like 2 weeks. I mean, we've been telling, potential, people looking maybe to sell their assets is, we're not going to do anything. Let's just kind of wait, see kind of what happens in April, and probably, make a plan based on then. Because again, as you just talked about, in deals that we're under contract on with buyers and sellers, I mean, there's kind of, Not even talking about doing due diligence. I mean, the idea of trying to get your due diligence done with social distancing, that's a whole other issue that there's going to have to be extensions put in to try to navigate these uncharted waters. Yeah. So maybe explain. So, like you said, rates went up a point. I mean, I guess the feeling was I was getting from lenders and talking to you was, it was almost like, hey, if you really need to get a loan quote today, this is what it is, but you better just wait and see as we get closer. Have you kind of that same sense? It was almost like, we don't even really want to take any loans because it's so chaotic.
It's more of what they're requiring outside of just rate, I think, is where the pain points are right now. I do feel we had a little bit of a spoils. I'm sure you've talked to a lot of clients. As last year started trending, it was kind of a shock. Rates went down start January. And all of us were just, and that's been part of the problem with financing as a whole, whether it's the agencies, the banks, residential loans, the refinance boom that was going. I mean, the project you and I are going to be closing here in a couple of weeks, we locked that rate at 3.7. And you want to talk about a pendulum. After I locked that at the end of February, by the second week of March, people started offering below 3% rates if you had lower LTV, which the Steele is. And I had to defend the fact that my client had rate locks. And then now, before we're closing, if we broke that rate lock, their rate would be 4.9% today.
Kind of that whole 10-year T-bill, when it dropped down to 50 basis points, it was let's rush to refund, and it was, amazing. So are in terms of, what are those new requirements? It's not just, as we've talked about, it's not just interest rate. I mean, there's other things in these. What are they requiring now that wasn't in place, the beginning of the year? Is it added liquidity, added reserves, things like that?
So obviously, yes and yes to both those questions. Before I jump into what we're understanding on new reserves, I do want to preface that what I say today could very much change in a month. We all know that now. As far as interest rates, the common call that I get is, don't worry about the reserves. Let's talk about that later. Why are the rates high when the government's 0%?
Right.
Why are the rates up? So I want to touch on that, and that'll actually tie into why lenders are now requiring payment reserves as part of closing a transaction. So I'm not by any means a Wall Street expert, but I do understand how the backroom transacts with a lot of these lenders that have allowed this low rate, low debt service, high LTV type market. I will say the refinance boom that started, a lot of payoffs and a lot of servicers and banks who service their debts were losing money and having to replace that with new volume. And then the coronavirus interrupted everything. So with the interest rates and going down to zero, the MBS market, or mortgage-backed security market, as we know it, the CMBS market, the commercial mortgage-backed security market, they have absolutely stopped buying. And so part of these rates going up, over half our multifamily lenders that we use as a mortgage broker firm at AMF Capital just stopped taking new applications. And so even at an increased rate, what I think is happening is twofold. They're trying to get the margins up to get the profit attractive to bring these buyers back, that allow these lenders to execute and originate loans, but not have the risk of losing it in servicing right after they book it, whether it's to forbearance, default, tenants losing their jobs, not paying rents, not getting unemployment, all the things that are risky right now, owning an apartment building. But I wanted to start there before I talk about reserves. And I think this is a big reason why what I'm about to say, the new requirements were implemented. Historically, whether it's a bank, Fannie Mae, Freddie Mac, life insurance, CMBS, the servicers tend to go to the investors with a pool of mortgages and say, here's your returns. Here's what it costs us to get that. We will do a 12-month buyback if these loans have any problems, any troubles of going to default in the first 12 months. And that's become the norm. And so with these 12-month buybacks, right now, there's a lot of servicers being told, you either pay us our returns, the MBS market, or buy back these notes. So we don't even have a new origination issue with interest rates. We have an existing what's been booked in the last 12 months. And so as more as these servicers lose, as more as these banks lose money, and they see the threat of more profit loss with forbearance requests by landlords, it's just kind of a sticky situation. And so with that said, the biggest change I've seen, aside from increased interest rates, specifically out of the agencies, which is Fannie Mae and Freddie Mac, banks, regional banks, credit unions, they all kind of tend to follow the trend of what Fannie and Freddie do, as they're the trailblazers of underwriting. They're requiring up to 18 months of principal and interest payments be front funded by the borrower at close outside of any down payment in the example of the purchase.
18 months.
Up to 18 months.
Wow.
Yes. It ties up a lot of liquidity. So if you're buying a property on pro forma, a property that someone might see could put in capital expenditures right away, some landscaping, a lot of that cash is now going to be diverted over to reserve accounts held. Now, where it gets a little kind of not necessarily set in stone, it is with the agencies, and what I'm seeing with banks, a little more flexibility. They won't allow you to touch this money while it sits there for the 18 months until the property is in trouble, until you're not meeting debt service.
Got it. Okay.
And I firmly believe we won't hear anybody confirm that has to do with the mortgage-backed security market being able to say our 12-month buyback guarantee still stands. We've put in a fail-safe should there be any interruption due to this coronavirus this year, that the property will not go belly up or won't suffer from, rent loss, tenant loss, economic vacancies and such.
So then the unknown will be just kind of, we're talking is, if this is a shorter term kind of issue, I guess, and it's probably negotiable, is that, or, is the borrower able to say we're back to, back to not social distancing and businesses are opening up? Is there, you've got this, 18 months or 12 months, depending on the deal, is sitting pot of, they able to get that after that? Or I think it's, and who knows, I would imagine.
Well, and that's a great question, Greg. The agencies have at least announced that to qualify to grab that money, there's 5 different qualifiers. And most of the 5 are if the asset's actually seeing trouble after it books over the next 12 to 18 months. And again, if everything goes back to normal in 3 months and all these book loans go, hey, we want our money back, they're actually making them wait 90 days post lifting of all government notices of the risk of this virus. So you're guaranteed when you close a loan until this virus lifts an additional 90 days before they'll give your money back.
Wow. Okay. Yeah.
Yeah. So it's locked up for a while.
So we're gonna, this is gonna be okay. What are you telling your clients in terms of, they're always trying, like I said, it was just literally, 2 weeks ago we're refinancing. There was this boom of refinancing, and is it kind of just a wait and see? Let's see how this plays out. It's April 1st now, and a lot of our clients are multifamily, some mixed use stuff, and the commercial investors I know, they've already kind of had conversations with their commercial tenants and trying to figure that out. We're kind of waiting to see the next 10 days. What does it look like here in this market in terms of tenants paying? Is there relief? It also feels like, as you said, kind of the agencies kind of lead the way. It feels that way too politically. You've got regional governments, state, kind of waiting to see what the feds are going to do in terms of stimulus, and then maybe try to back into that. So it's just, what do you tell your clients in terms of kind of what's the landscape and what to do in the short term?
Quite honestly, if they were to have the cash to front a 12 to 18 month reserve, I tell them, let's see if the seller participated more time to close, and let's see if this burns off in a couple of months. Yeah. All this changed faster than 30 days. It could very well do the same on the other end. And I don't want to get into debate of this virus and how deadly it could potentially be and how long it lasts. But I am advising clients and purchases, if a seller has to close, because you're going to have those transactions where sellers already have obligated themselves to something else. Maybe it's a partnership breakup, numerous amounts of reasons. We've seen sellers participate in doing a seller credit and or having some of that purchase price come back to fund that account to allow these buyers to close on the deal without constraining so much of their cash. So that's not as many, but that option's been there. And, consult your tax. Anybody should consult their CPAs to make sure any of those decisions to make a deal work doesn't give them a taxable event.
Yeah, because there's now that, some things have changed in terms of, loss carry, in terms of some losses. There may be some offsets on that. We've had some clients, I think, have some concerns, and, are they going to do they get a 1031? Is there an extension on the 1031? That's not set in stone yet as of this taping on April 1st. That may change. What are you seeing for, is there still interest only in this environment? Are we kind of, is that, kind of pie in the sky, or is it,
It's really pie in the sky, and it really is the mom, pa, smaller investor is likely not going to get interest only right now. It really seems like it's a case by case. Fannie Mae is not considering any interest only unless it's 55% max LTV with a 155 debt cover. So basically, if you're already in those merits, you probably don't need interest only to make sense of a deal. You just choose to have it. They would probably bless it. And Freddie Mac is still considering interest only on all levels. However, it could require even more months of reserves put away if that is blessed. And those reserves are not based on an interest only, because a lot of creative, smart people in your industry might say, all right, I'll fund 18 months. You're going to give me 3 years of interest only on my 10-year term. Are you going to base that 18 months on interest only? And that's a line item in these recent announcements about reserves. They will base it on principal and interest payments. So that
it will. So it's got it. So it's not on the interest only. Interesting.
And the banks have pretty much done away with interest only. Banks, credit, when I say retailers, I'm referring to banks and credit unions.
Our clients come to you and saying, Tim, I need to talk to my lender. How do I start the process in forbearance? If that's the case, do I get it? Those discussions that have come up, I'm sure. Do you give some direction on that?
Yeah, and very little direction because we're still learning. But the CARES Act, that was part of the stimulus package, I'm immediately having people go read those links and sharing that with them, even though a lot of it does not pertain to the investor, the risk and the reward of what we do for a living. However, there are, some investors that employ people to run their assets. And because lenders are going to ask, whether it's your incumbent lender on other deals that you've already booked in the last couple of years, if you're talking to them, they're going to ask, have you exhausted all of the stimulus options out there?
Got it.
And so if I start them on the CARES Act, I try to educate people to get informed with what is there. And if you qualify, you exhaust those options before you talk to your lender.
Okay. Well, it's kind of a crazy time. I'm almost feeling like we should, almost take this up in 2 weeks and see, what's changed between now and then. Because like you said, the CARES Act just came through. We've got people, looking at it. Do they go get an SBA loan for some of this business? Are there tenants on some of the commercial tenants? Are they able to get an SBA loan to kind of help them get through this process? And is that money going to flow then back to the property owner to help them pay, their mortgage and maintenance and things like that? It's a very weird time in that regard on how it's all going to shake out. And it sounds like everybody's kind of waiting for the Fed, and we'll see what happens locally in terms of help. So
yeah, unfortunately, I'm already hearing stories of businesses that are booming. They don't need it, and they're still asking their lenders for forbearance because why not? And to those people, if you watch this early, I just say you're only clogging the system for people that are in need. It's a domino effect. You're absolutely right. I'd be curious what plays out. If somebody does get some SBA funds and they still try to call their lender, will they pay their rent when they get some relief, or are they going to try to hold on to money for reserves and still tell their landlords, I didn't get any money? How do you hold your tenant accountable to prove paperwork that you've done everything you can? And that's where I would tell landlords to follow the lender's suit. Is if you have a larger tenant, specifically in a mixed-use building, say a commercial retail tenant or anything, is ask them for proof. A lot of this stuff is not in their lease. Acts of God are in their lease to not pay. And, I don't believe this is an act of God as far as any measurement. So they're asking to be creative. I think the landlord should ask their tenants, prove to me that you've exhausted these other options available to you.
Yeah, multifamily, there's, tenants are supposed to show that it's been effect. And I think, in the short term, I think most owners are going to, work with people and try to figure this out. It's just going to be, if there is some relief, it has to get back into the system, and how that happens will be, like I said, we may be having a completely different conversation in 2 weeks when we do this again, kind of as an update of have things changed, where it's going to be. It's a very interesting time. It's very unsettling in terms of where people are, because it's just such a moving target. Nobody can really get an idea.
And that's just it. Do we jump now and fulfill our contracts and get them done? I've got clients that started with their bank that they already banked with, and they got put on hold, and they're just going and getting a bridge loan, and they're getting a 6-month, 12-month bridge loan, interest only, no prepayment penalties. And, to be able to fulfill their contracts, get the deals done, pay off their investors, cash out to buy out a partner, whatever the situation may be, and then go get perm financing when all this lifts. And if it doesn't, at least they're kind of already educated on where it's going.
Right.
I will say the biggest risk in doing something like that is, what is the stabilized value? Because right now I've talked to a ton of appraisers. My banks that have current projects, our projects in Sherwood, they've called the appraisers again, even while drafting loan docs, just to make sure, we're not overextending ourselves in a potential collapse. And all the appraisers, commercial, multifamily, they're telling them there's no effect on value right now. Even temporary income disruption is not the grand scheme of where the market and the commercial real estate market will go. We got to pay more attention to how many people are going to get back to work when this lifts.
Right. And I've had a handful, tons of appraisers calling the last, week just asking the same thing. And, it's funny because it's kind of like we're almost too early to have this discussion. I understand I would say to them, I know your clients or the banks want to know, we really haven't had an effect. There hasn't been enough data points for values that have closed. The question kind of back to the bank is, what are you doing from a lending standpoint? Because I think that's going to have a huge effect if these kind of requirements stay and rates stay where they are. That will have some effect. But what it did today in value, the building that's closing today would have, what's it worth? 2 weeks ago, it really hasn't been that big of a change. Now that may all change in 30 days. We just don't know.
And a few things I'll add to that just for your viewers here. If you do have a mixed use building right now with these same changes, they're not counting any of the income, even if you have an occupied tenant paying rent.
For the retail?
For the retail, the office, the whatever the mixed use component is. They want it to debt service on all these stressors added in retroactively by multifamily only. And that's been kind of true for some of the multifamily lenders historically. But yeah, that was a big one. So that'll be nice because if you buy something that qualifies on apartments only, you won't have so much of an issue if your retail tenant doesn't pay, besides just maybe some irritation. But on the MBS market and the servicers, I just want to stress to people, whether you call me after this and ask for help or you're working with your own banks, kind of the side effect of low interest rates and really competitive loans we've seen in the last 5 years that are relying on Wall Street, they're going to have a harder time being flexible, because if they grant a forbearance for 90 days to a current deal that you have, they still have to pay the investor that owns the note and the mortgage-backed security.
Right.
And until we get participation out of those investors on Wall Street to allow the break to happen, will it trickle up to everybody proactively? So what I would tell your viewers and your clients, if you are working with anybody currently, if it's a portfolio bank, a smaller local bank where they already had higher interest rates in the market when everything was low and competitive, you're probably going to be okay in that sector than dealing with these conglomerates we're all used to.
And that's something we've been trying to educate some of the leaders politically is to, there's a portion of the lenders that, in terms of multifamily that they'll be able to work, but there's a large percentage that's not the case. Like you said, is the investor going to take that? So just saying, we'll grant forbearance. Well, that's works for a portion. I think the VA is doing that now on homes, but for multifamily and commercial paper, that's not the case. And I think it's been a little eye-opening when you talk to some of the people making decisions as to they really didn't fully understand that. And so hopefully, together everybody can kind of work together to try to kind of work through this thing. Because again, nobody knows how long it's going to be. How many of the job losses are going to come back. We're just not sure.
Well, what I do know is we know when we hear if unemployment goes to 30%, I think that's the biggest number that's been thrown out. We know that's temporary. Yeah. I don't think in the history of ever that's been permanent. So I say that about real estate values. Even if we have a 90-day thing where your clients experience 30% economic vacancy, and I know your clients know what that means. It doesn't necessarily mean someone didn't pay rent for the whole month, but the discounts given could all come up to about a 30% of collection. And lenders should know that's not forever when we get through all this. Because the next conversation we're going to have is, did some of these new parameters in lending lift? How are they treating the trailing numbers that we now know landlords had to go through during this pandemic? And I think that's
a conversation we've had. I had a couple of appraisers about that. If just their kind of the thought was, if it's a 30-day, 60-day, 90-day, it's almost like you may see, well, we're not annualizing, we get to year end 2020, we're really not annualizing this year. It's kind of like, okay, we got to pull these months out. But again, it's going to be the length of time and how this thing works. So thanks for taking the time today. I know it's been busy. I will put on the calendar. I think we should do this real good and soon, because again, it's such a changing atmosphere, and what you say today, again, this is April 1st. I want everybody to remember that. So, we'll have another one of these very soon, because again, the market is changing rapidly on a daily basis. So
I'll keep you guys updated and happy to do it again. I think every 2-3 weeks is going to be necessary.
Definitely. And if you want information, get a hold of Tim. His contact information is below. We'll make sure we get that to you. And they've been a great resource for us in our business in terms of keeping us abreast of the lending environment, both, like you said, the small commercial banks all the way to Freddie and Fannie and the agencies. And you've got to, in times like this, you've got to really look at all your resources. I think the days of just kind of pigeonholing you to one option, probably not going to be the way it's going to go. So again, you've got to keep your avenues open in different ways to try to solve some of these issues. So again, thanks, Tim, for doing this, and we'll talk to you soon. Alrighty, thank you. See you again next time on HFO TV. Thanks, Timmy.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.